Welcome to the Fixing Incentives podcast, where we talk about the incentives that drive success. Now, let's get started with the show.
Hi, David Malaman here. I'm the host of Fixing Incentives podcast, where I talk with top business leaders about their journey and the behavior that powered their growth. I have today with me a really amazing guest, and I'm really looking forward to it. And we'll get right into that in a minute. But first, here's just a brief message from our sponsor. This episode's brought to you by Tenfold Traffic. Now, the only projects I take on are performance-based relationships. What that means is all marketing goes through me on my own dime, and we negotiate some sort of revenue share. I don't want someone giving me money if I don't generate a return for them. But when I make someone a ton of money, I want to share in the revenue. And that's one of the reasons actually why I started angel investing and why I'm doing this series with syndicate leads from angelists and other venture capitalists, because I was looking for, if I invest in a company and then I get involved in some way with advising or with marketing, I would have the ability to really realize the full value I create across that business. So that's why I got started originally. But since then, I realized I'm probably not going to get involved with marketing with any of these portfolio companies. But it's, that's what led me there. And it's been an amazing learning experience. And I'm really excited to jump in. But if you are a company that has a converting funnel, knows the lifetime value of a client, and you're really in a place to start, pouring fuel on the flames of your customer acquisition, definitely reach out. You can visit my website, davidmalamed.com, or email me at david@tenfoldtraffic.com. First, the guest that I have was introduced to me by Jack Coleman from Fourth Realm VC, which is, I've done some early stage deals with them, some secondary investments with them. And they said that I asked who else in the, angel investing world is a great guest to have. And they said that by far the number one person you should try to get on the show is Peter Livingston. So I'm really excited to have Peter Livingston here with, he's a longtime angel investor and general partner and founder of Unpopular Ventures. And they're looking for the best companies off the beaten path. And I just to kick it off, I love that off the beaten path idea. I suspect there's a lot of founders that self-exclude from raising money because they're convinced they don't have the relationships, they don't have the access. I know when I read up about startups and raising capital, one of the most common pieces of advice I see is get introduced to the investors through someone someone that knows you. And I'm not just talking about someone who's like underserved, underprivileged, coming from a third world country or underdeveloped area. I'm talking about you could just have a regular person in the neighborhood who has a great product and idea, and they're starting to get traction and making progress, and they could really scale if they have the right strategic investors and partners. So I'd love to know, Peter, tell me a little bit about how you came up with this idea of Unpopular Ventures, how you developed, let's call it, the courage to seek out the opportunities that maybe the Sequoias of the world are not even giving the time of day to.
Yeah, well, to start off with, David, thank you so much for having me. It's my pleasure to be here. And thank you also for the incredibly kind words. I'll have to get the name again after we're done of who referred you to me to send him a thank you note. Because, gosh, that's incredibly nice. I'm turning a little red, but thank you so much for the kind words and for having me. To answer your question, so Unpopular Ventures, and yeah, we try to focus on finding really great companies backed by great founders that are just a little bit off the beaten path or a little bit uncomfortable for other people. And where that comes from is that, one, in all my reading and studying of successful startup history, almost all of the super mega successful companies were unpopular in the beginning. And then also in my own experience, I have a huge, like when I was first starting out, or even before I started angel investing, and then even when I started angel investing, I missed some wildly successful companies that I thought were just terrible ideas in the beginning. And so I've been exposed multiple times to these super breakout, mega successful things. And I distinctly remember looking at them at the beginning and thinking, that's stupid. It's not going to work. And yet those were the ones that were mega successful. And I could go through some of the stories. So one was a fraternity brother of mine founded Instagram. His name's Kevin Systrom. And he didn't directly approach me for funding, but I remember hearing that he was starting it. I remember hearing he was trying to raise a little bit of money from some friends. And I could have easily reached out to him, but I downloaded his app, which was called Bourbon at the time, played around with it. I was like, I don't get it. It's kind of stupid. And gosh, if only I had invested. He pivoted a few months later. It became Instagram, exited for $1 billion 18 months later. And I would have made a ton of money. And so that was one. Another was the DoorDash founders were very good friends of mine in business school. And I was even venture capital club co-presidents with them. So I knew them very well. One of them has told me they were starting something in food delivery. And I immediately thought, food delivery, low margin business, not that sexy. And I'm not like, again, they didn't necessarily approach me for funding, but I knew they were doing it. I was actively looking for investments at the time. I could have easily just been like, hey, can I put in a little bit of money? And I didn't, because it seemed like a bad idea to me at the time. And those and other learnings led me to realize that some of the biggest and most successful things out there start out looking like bad ideas or are a little bit uncomfortable to most people in the beginning. But the thing that ties them all together is they're usually started by pretty smart people and that are very ambitious. And I think that is this dangerous combination of like doing something that's off the beaten path. Seems like a bad idea, but really talented people that are chasing that. And so forever after now, there are smart people going and doing something that seems weird or unpopular or off the beaten path. I run towards that. I'm trying to not make that mistake again.
I assume that there's some signaling on the other side to this. I shouldn't ask about bad investments, but were there ever an opportunity that you saw that you're like, this is the worst idea ever, I better invest, and then it turned out to actually be the worst idea ever?
Of course. I mean, that's venture. I mean, so VC as a whole, you have a ton of losers. I mean, that's just part of the game. But the thing is, in this game, you only lose 1x your money when you lose, and you could potentially make 1,000x or 10,000 times your money when you win. And so it always sucks to lose money. I hate it when it happens, but I try to let go of it because, yeah, it's like if it's 50-50, if it works out, or even 25 chance it'll win and 75% that it doesn't. If it wins, it's 10x or more, you should always make those investments. So sure, I have failures, try to learn from them. But the truth is, it's really hard to predict. And I think you just got to get out there and try to make a lot of investments and hope some of them are those mega successes.
Got it. So something interesting I noticed, when you talked about these companies, you talked about their ideas, but when you talked about investing, you talked about smart founders. So like the Instagram and DoorDash examples, were those people that, looking back, regardless of the idea, if you had that kind of heuristic that you have today about what type of founder you're looking for, what qualities, did you see that in them, or were some of those complete surprises?
No, I should have seen it in them. Very smart guys, very driven. So the Instagram founder, for instance, had a ton of phenomenal experience. He had been through multiple startups. He had been a product manager at Google. When I knew him in college, like he was clearly a very smart guy. And same thing with the DoorDash founders. They were very smart in class, very driven, and they were just people that you should bet on, or that I think you should bet on. And kind of the way that I define what I look for in founders now is just a track record of success. Have they done things in the past where they were successful or did remarkable things that gives you at least some amount of confidence that they're likely to succeed again in the future, or in anything they do. And when that's the case, I try not to overthink it. In fact, right now, I'm at this point where any smart friend that I know who's starting a company where I just think that they've been around the block and they're pretty smart, I always invest, even if the idea is bad, or even if I don't get the idea in the beginning, because these companies always pivot. Even if the initial idea doesn't work, they often, the smartest, most driven people often find something that does. So when you're investing at the beginning, it's all about people.
Now, are most of the investments you're making pre-revenue or fairly early on, or what makes a company ready for Unpopular to step in and participate in a round?
Yeah, so it depends. So we certainly invest pre-revenue in a lot of companies, and when we invest super early, it's usually because the founder does have a remarkable track record of success. If there isn't as much of that signal, or we're not sure if they're kind of operating in a space where they can find that product market fit, then we do like to wait a little bit more. So we do often invest also when there is some traction, and we're happy to pay a higher valuation. I think that probably 2/3 of our investments are what I'd call right in the middle of seed stage. So like they have some amount of traction. There's some early evidence that they have a product market fit or something's working. So we do usually look for that traction, but then actually it's probably like 50% are right in there, maybe 50-60%. About a quarter to maybe a third are that super early, where it's just an idea, but it's a remarkable founder or founding team. And then we do some that's later too. So we'll do Series A or Series B, but it's a rough slice.
Are there any investments or founders that you're really excited about because you feel like, these people are just, no matter what they're going to do, they're just going to succeed? Is there anybody or any companies you're able to talk about that you just, tomorrow they're going to be the story that the people that didn't invest are going to talk about how they were buddies from college and missed that opportunity?
Yeah, right. Well, so first, we love all of our children equally. They're all great. We really want them all to succeed. I wish I could talk about all of them. Our portfolio is pretty big now. We've invested in over 150. It might actually be over 160 or 170 companies now. I haven't looked at the exact number lately, but we do have it's not just me. It's a team of 5. We're investing very actively. We have a big portfolio, and we have a lot of companies that are doing great. And I feel incredibly lucky that they allowed us to participate in their journey. So thank you to all of our portfolio founders for letting us invest. If you want to zero in on one, when you're investing in startups, you go in with a long time horizon. You expect it to take 10 or more years. And oftentimes the best investments are quiet for many years. It's not clear they're going to be successful. So it might be 3 or 4 years after your investment where they're still figuring things out. And then they hit their groove and then are grow like crazy, or widely successful later. But then sometimes also you get these early winners where they just take off right away. And so given that we're early in this process, we don't know who the biggest long-term winners will be, but we do have a few that are really breaking out quickly. And so one that I could talk about in that vein is a company called Jeeves. They're building a global business bank. They started as a corporate credit card for international startups, so kind of like a Brex or Ramp, but focused on initially Latin American startups, but now a lot of other countries around the world. Last I heard, they're in 26 countries on 3 continents, and they've now expanded beyond just corporate credit cards to full expense management. And now they're doing revenue-based financing, and they're building a whole suite of products where their vision now is to be the global cross-border business bank.
So I didn't catch the name. You cut out for a second.
Sorry, the company is called Jeeves. Jeeves. And we just got incredibly lucky so we were their first investor. After Y Combinator was technically the first investor, and then while they were in Y Combinator, we were the first actual investor aside from YC. We saw it because the founder was a good friend of mine from business school, and they also were building a great product. He had a great experience, and they also had some early traction with customer sales, and were growing fast. And so we were able to invest quite a bit in them, and at a $10 million valuation initially. And they've just been a rocket ship. It's public news. I can talk about it. They've raised 6 months after we invested on 10, and Andreessen Horowitz came in with a lot more money at a much higher valuation. And then just in the last month or two, they'd raised another round from CRV and Andreessen Horowitz at a $500 million valuation. Wow. So it went from 10 to 500 in about a year. So it's at least on paper, it's doing great. And the traction is there, the execution is there, their numbers look phenomenal, and they're growing like crazy. So if you want to judge today, that seems to be our first real breakout winner in the portfolio. Although there are a lot of others that are doing great too.
That's amazing. So was the fact that they were in Y Combinator an important signal early on, or what, do you recall your initial discussions with them? What made you feel like this was, a good bet?
Yeah, well, so I don't know that they needed Y Combinator, but YC does help. Both YC picks great people and great companies that tend to be successful, but then the coaching that they give and the network that they give is really helpful as well. In the case of this company, they're selling to other startups, particularly global startups, and YC plugs them into a huge network of global startups. So it's a good way to get customers. The founder had a great background. He had previously co-founded another company that they raised a good amount of money from great investors, grew it to 45 million ARR, and the company's doing great. So startup experience, it's not always required, but I do find that founders that have been part of a startup before, they hit the ground running much more quickly in their next one. And so just as a signal of how likely they are to be successful in the current venture that we're investing in, seeing that they've kind of been around the block a couple of times in startups, finding that product market fit, growing it, it gives us a lot more confidence that they're likely to succeed again.
Got it. Yeah, that reminds me. I think I read somewhere once upon a time that one of the things YC at least used to push early on is showing growth week over week, for sure when you're in the program. So that hit the ground running piece seems to be really important. Just speeding up that learning cycle. So
that's exactly right. No, I mean the best startups move fast and track their metrics super granularly. So like I see a lot of startups out there where it's like they're presenting their growth year over year. And when I see them and often meet with these companies, I say, you're a startup. You're supposed to be moving lightning fast. Why are you tracking and reporting numbers on a year over year basis? You should be doing at least month over month, if not week over week, and month, and trying to improve it every week, every month. Those are the ones that kick ass because they're trying to be quick and move fast and learn as quickly as possible. And I think YC helps a lot with getting them in that mindset.
Yeah, I'm sure the cohort also creates that kind of peer pressure. To really,
it's true.
It's I think they stumbled upon a really brilliant insight that maybe Napoleon Hill talked about with the mastermind, but I think that cohort idea is that's my feeling. Sometimes product market fit is not this like amazing. Like I look at take MicroAcquire for example. If you see them right now, they feel like a rocket ship to me. What I see them doing, and to me, the idea was just like I'm not quite sure what they did that was so special or so unique that was different than all the other marketplaces and forums and places that you could buy, micro SaaS companies and startups. And I think that one of the things that Andrew hit on with that startup is maybe the anonymous nature of the seller, where a seller can kind of like on AngelList 2, you have syndicates and you have to be invited in before they could even, that's probably because of compliance reasons around marketing securities, but that it creates a certain, I don't know, a certain comfortability. People are able to share more information, be more transparent when the people they're sharing it with are carefully vetted. And I feel like sometimes, like with YC, I think my guess is just the cohort was a smart enough insight that almost everything else was irrelevant. I feel like sometimes you just have these startups. I don't know if Jeeves is hitting that with what they're doing right now, that they have that traction, but it sounds like an amazing company. So that's very cool. You mentioned earlier, I have your quarterly update from November open in a tab, and you mentioned you didn't recall how many investments you've made so far. It's actually more than you recalled. You have a little table that shows you only started in 2019 with about 24 investments or 22 companies, and you're at 193 investments in 150 companies. So I guess that's 43 that you've done follow-on investments in existing companies. When you do those follow-ons, are those also offered to all your LPs? Okay, very cool. So like, because
not necessarily all. It's a delicate situation. So sometimes our follow-on allocation will be too small, and so we do first offer that to the people that invested before, and also our fund LPs get priority for that. But if we have additional allocation beyond that, then it goes up to the syndicate to everybody else.
So that's something I'm very curious about. It feels like there's so much money in the market right now. And maybe it's just because I joined a ridiculous amount of syndicates on AngelList. When I look at my no, I mean, I think I'm in like 100 or some crazy number. And I'm also, I must have made 150 investments by now. Some of them really small bets, just because I wanted to really learn everything going on. And one of the things I loved about your investments, and I've only done a few small ones, were you're very thorough in the information that you write and that you share. And I don't know if that's something you picked up in business school or you just put in the hard work and other people aren't willing to do it. Your quarterly updates are, I mean, you have to want to read it because there's so much information. It's true, which is like a dream come true for me, because I'm literally, part of my goal here is just to learn. I love learning new things. And it's fascinating seeing how all this plays out. I can't wait to fast forward a year to actually see what happens with a lot of these positions. But so I'm curious. I don't see you overselling with your offerings. I'll sometimes actually even see messages for the same offering from 2 or 3 different syndicates, and I even noticed once or twice with different terms. So as an LP, what I'll look for typically is what their investment is. In if they're only putting in 1,000 and they have a minimum of 2,500, that, to me, that's a signaling problem. But when their investment's there at 20,000, or something like that, and then you can invest 2,000 or more, to me that says that they really buy into this. One thing I'm really afraid of, because I don't understand the fee structures super well. I understand carry, but this podcast called Fixing Incentives, everything I do about marketing, it's about really just understanding people and what drives their behavior. So, I'm very curious why you've been a little unpopular in the way that you're not overselling these deals with, just really pushing FOMO and pushing, Elon Musk's cousins, twin brothers, a lead investor. Like you're not pushing this like narrative that other people are. Instead, you're providing like really thorough information. At least that's what I've noticed on the deals that I've seen. Is there something that drives that within you, or how you approach these investments that allows you to do that, or that inspires you to do that?
Oh gosh. Well, thanks first for saying that. And you touched on a lot of different things just now, and I want to answer a few different things that you brought up. The first thing that I want to go back and answer is you mentioned that you've done 100, 150 investments on AngelList, and my honest opinion is that you're already in a better position than the majority of people that try angel investing. One of the biggest mistakes that people make when they first start angel investing is that, well, they probably don't have much deal flow yet. So the first company that comes along that they see, they get super excited about and plunk a third of their money into it, or a third of their angel allocated money to it. And they just don't build a big enough portfolio. And so kind of the 2 ways that I see people lose money in angel investing is, 1, they don't build a big enough portfolio, and 2, they deploy it all at once. But specifically on this first point, like, I don't know anybody, I haven't come across anybody who built a large portfolio of at least 50 investments, and was understood the time frame, understood it was going to be a while. I don't know anyone who did that and lost money in angel investing. Certainly there's a spectrum of how good the outcomes are, but the very fact that you put in small amounts, you built a big portfolio, sure, a lot of them are going to fail, but in aggregate, I feel extremely confident that you're going to end up with decent returns, and you're going to get at least your money back and good returns on top of it. You're going to do great. It's great that you built a big portfolio, is what I'm trying to say. So,
thanks.
So to your point about the overselling, the hype, all this stuff, it's a really tricky issue. What makes it tricky is that it works on people. So I probably before you joined, I experimented with that in the past. It's actually crazy. So you've probably noticed that on AngelList, people are always talking about how oversubscribed they are, 2x oversubscribed or half subscribed or this or that. And they're always the reason they're doing that is that when you send out a message on AngelList with the word oversubscribed in the title, you get a bunch more money. It's like, it sucks, but it is clearly some kind of hack that hits people psychologically with scarcity or social proof or something about this that causes more money to put money more into those deals. I hate that it works that way. I wish it didn't. But the reason all those people are doing this is that it works on people. I think it's kind of like how nobody likes to think advertising works on them, but clearly advertisers spend a lot of money so it's clearly working on people, even though people don't like to believe it. It works. But with me and our team, we've talked about it, and we just think it's gross. It feels like people are lying. In fact, some of these syndicates will go and get a $500,000 allocation, but then they'll agree with the founder, we're going to do $500,000, but then they'll put it up as $100K in the syndicate. And then once they fill that $100K, they go and they're like, oh my God, we're so oversubscribed. Like, oh, like I went and begged the founder for more, and oh, luckily he gave us more, and oh, thank God, now we're at $250,000. And they'll be like, okay, now we have $150K. And they fill that, and then they send another email. They're like, oh my gosh, we're so oversubscribed again. And it's all a lie. They had a $500,000 allocation. They were never oversubscribed. They're merely hacking people's psychology. And so anyway, the behavior, in our opinion, is gross and unethical. And we've decided to stop doing it. Probably to our detriment. Like we often don't raise as much money as if we had been overhyping these things and talking about how oversubscribed we are. But we do really care about our reputation. We're up here in front of 2,700 LPs in our case, and we want to do everything we can to earn the respect of everybody. And we think behaving that way would lose people's respect. That's why we behave that way. I'll pause there and see if you have any questions, and then I could answer another thing that you hit on.
Sure. Yeah. So, I mean, I've so many around that. This goes to every deal I see on AngelList has this big warning about confidentiality. I know that there is one company, I want to say it's called Travis, but I'm probably getting it wrong. Vincent, Get Vincent or something like with Vincent, that it is trying to be an aggregator of alternate investments. But with the need for confidentiality and the speed of transaction, for me to invest, I'm literally checking 5 boxes and hitting invest. Is this something that AngelList or other marketplaces should be fixing? Is there what would be how would you solve that broken incentive or that problem where the LPs don't really have the time to do the same type of due diligence that they're hoping the syndicates are doing? And more importantly, if there's fees that they make up front, they might be incentivized to just bring up, as long as there's a lead investor and they can get an allocation, just float it out and partner with their buddies and across AngelList for their allocations, and just copy and paste some things that they have and just push it out. What do you think? Is this pushing people off platform to do private deals with Assure? Is it what do you see? I'm curious, from the LP side, what do you think is the right way to fix some of those broken incentives?
Absolutely. Well, I love that you're so interested and focused on incentives, and it's something that I am too. I believe incentives make the world go round, and I spend a lot of time thinking about them. So I think it's really cool that you're similarly nerd, maybe nerdy about it in the same way that I am. So I've actually thought about it a lot on AngelList. So to put it in context, so on AngelList, there is no upfront fee that any lead receives, at least in syndicates. So when you invest in a syndicate, the lead does not get any cash right away. So that's good. At least they're not incentivized to just put up a lot of crap too much. But there is actually still a broken incentive in how this is set up. So the potential incentive problem is that a lead could potentially put up a ton of deals, do the absolute minimum, do 1K themselves, put up everything that they see, raise a lot of money onto each one, and they could potentially lose money in aggregate to their LPs. But if they have one of those deals that does pretty well and exits for a multiple, that lead can make money, even though on average all their investors will lose. And so that is a broken incentive where, because of that, a lot of leads put up just tons and tons of crap that they haven't diligenced, because they know they'll probably get the money. And even if they lose on most of them, hey, at least probably a couple will work, and they get this free optionality where they'll probably get some cash out at the expense of their investors. So it's something that people have complained about in the past, and it's something that I think is dangerous and concerning. And I've actually tried to fix it in the way that we behave. And the way that we have tried to fix it is that we publish our numbers on a quarterly basis and show both the detailed portfolio, like what we've invested in, how it's all doing, and then also the aggregate numbers, with the intent that, hey, sure, we could go and try to make money at the expense of our investors, but that's not what we're trying to do. We're trying to make money for everyone. And when our investors win, that's when we want to win too. And so by holding ourselves accountable and reporting on our metrics, and in fact, on our own team, we have our own dashboard where we show each partner's metrics by year. And the expectation is that every partner should be doing deals in a way so that they produce an aggregate net positive return for the investors.
Got it.
It's not perfect, but at least by holding ourselves accountable and trying to produce good returns, and not leaning into that potentially misaligned syndicate incentive, we're trying to do better. And luckily, so far we are.
Do you find that investing in rolling funds, or I think you have preferred access funds, does that help fix some of that incentive a little bit? Because at least you're participating in multiple deals.
Yes and no. With the funds, so most rolling funds charge management fee, and the management fee, most of it actually gets paid out up front. So if you do invest in rolling funds, those leads actually do get cash out up front. So they are incentivized to raise as much money as they can, and they're going to make money even if they lose money. Having said that, in terms of the investing and the portfolio level, they don't get into their carry until they return the whole portfolio. So at least they can't make money off of just one deal that does well, even if all their investments suck. They do have to return the portfolio to get into carry.
Got it. But I guess if they're getting that money up front, it's a different broken incentive, but it doesn't solve the problem completely. So I guess over time, there's a certain amount of trust that people can build up. I guess that's one solution here. But that's interesting. So
you're actually, I realized I meant to answer that as well. You're exactly right that the LPs are in a position where they have to trust the lead. It's hard to tell how much diligence they've done, other than what they've written. It's hard to know. Yeah, if you invest behind leads on AngelList, a lot of it is basically trusting the leads. And so with that as well, we've been trying to build our track record, publish our numbers, report regularly, with the intent of saying, look, like, we're doing the best we can. We're not always right. We do lose money, but on aggregate, we do well. And we think that we are worth trusting. And certainly it's up to the LPs. LPs would prefer to invest direct. They can go and try to do that. And so it really is an individual decision that's left away.
Got it. So I do have one other question I wanted to cover, but you mentioned that I asked the question earlier that had a different point that you wanted to address too. So what would you rather do first?
You go ahead. I think I got most of the things that I thought were worth addressing and what you shared.
Okay. So there is one company I participated in that you are working with, I don't know if I'm allowed to talk about it or not.
You can say the name.
But it's because it's a topic I care about, which is frame fertility.
Oh yeah. No, I'm glad you joined us on that.
So I'm married for 11 and a half years now. We don't have kids. We went through the infertility journey. At this stage, I'm comfortable talking about it publicly. It took a long time. I understand the emotional stress and pain that goes through it. It goes deep to your core. But in our case, it was male factor. So it's an issue with me, not my wife. It took us 3 years, 3 years of doctors to even start testing the male side, even though 50% of explained infertility is male factor. So I think I don't recall everything you guys wrote about frame fertility, and I'm not trying to get into a fertility discussion, but anytime I see a startup addressing the issue, especially around early information, that helps you understand. Because in my case, what it is that I'm dealing with is it hasn't impacted my life in any way, shape, or form, medically or anything until we were ready to start trying to have kids. So I'm very curious about frame fertility, what you liked about what they're doing, or I don't know how much you could share about what they are doing and what progress they're making, but this is one of those markets that the data might not even be there to let you know how large it is, even though it's, I don't know, 1 in 8 couples experience some sort of, and the number's probably even bigger than that when you start getting into secondary, people that have 1 kid and then, go 8-9 years, and, treatments are insanely expensive, and doctors are, and half of the time they don't know what's going on. So I'm curious about that company and that investment. Are you kind of bullish on them? Do you feel like they're doing real? I'd love to see what they're actually doing to know if they're going to actually put a dent in making life easier for people with this very private, very personal, and very painful topic.
Happy to share. First, I'm very sorry to hear about your challenges on this front yourself. It must have been incredibly hard to go through, especially with how opaque the system is. And that is crazy that you went through 3 years of trying to figure this out, and they didn't even look at you for 3 years, which is clearly the system is broken. I'm so sorry you went through that.
I appreciate that.
Congratulations on your 11 years of marriage. That's fantastic. This one is actually easy to talk about, and we don't have to talk about anything confidential. So there are a few kind of signals in that exist in startups where I almost just always auto invest. Like it doesn't matter what being completely transparent. I know very little about the fertility market. It's not a space I have expertise in. In this case, it was primarily a judge of the team and the signals around. So the first is that I'd known the founder for a long time, or one of the two founders, Corey. It's a husband and wife team. Corey I've known since, I think, 2007. And we actually spent a lot of time together in San Francisco. Knew him then, knew he was super smart, very driven. And then since then, he's been very successful in his career. So I don't only invest in Harvard and Stanford for graduates, but it's certainly nice. He went to Harvard Business School. Clearly smart guy to have gone through that. Just to be clear, with all founders, you don't have to go to Harvard for me to invest in you, but sure, it's a marker of past success. But then, in addition to that, he went through multiple startups very successfully. So he was at Synapse, and I'm not going to remember all of them, but basically he had very specific expertise in health tech startups. And so did his wife in separate health tech startups. And then the clincher for me was that they left to start this new company, and 2 of their former bosses, the founders or CEOs of the prior health tech startups that they worked at, were angel investing in this company. And when I think about checking references, I really think that there's no higher reference than your former boss investing in you, particularly when they have expertise in what you're trying to do now. And so that right there, literally, that's all I needed to know to say, I want to invest. And I don't know if the ideal will work. I don't know if, we will, I don't know how big the market is, but I think that if there are people like that with that kind of experience and all these people who have worked closely with them who believe in them so much, even if this initial idea isn't exactly right, they're going to find a way to success. So it was a bet that I thought was worth it.
The market is massive, except for it's a problem that people don't think that they have until they have it. So if part of the goal is early intervention or early access to information, and I don't know exactly what they're building. I wasn't sure if it was more behavioral health tech that was. I don't know. I mean, I don't know if you're able to share anything about what they're actually their current iteration that they're working on is, but it's
well. So actually, that is stuff that is more confidential, and
okay.
In fact, they didn't want all that information up on AngelList. But in general, it's a digital fertility advisor. They collect data from a whole bunch of different things, both the questionnaire, tests you do. They aggregate a ton of information that allows them to basically judge how fertile you are likely to be, probabilistically, and that it can then also recommend actions that you can take to increase your likelihood of being able to have children.
Got it. So I could just address that point you just mentioned. The first probably 9 to 12 months of fertility treatment, or when you start going to the doctor, when you start realizing there's a problem, is almost all around timing. So that's their first attempt is, because I think the number is something like 40 or 50% of infertility is actually unexplained. They actually don't know why it's happening. And in many of those cases, it is as simple as just, the stars aligning. So if that's what they're covering, that first year and that unexplained, at least with that one point you raised about them, about that, just, collecting information and give you good information. It's actually clinically what they do right now. And it's a pain because the way they do that is you're going to the doctor early in the morning, you're drawing blood, they're doing ultrasounds or whatever else. It's kind of annoying and invasive and uncomfortable. And it's a challenge. My only advice to that sector is anybody approaching that market should recognize that while couples go through it together, they also go through a very private, personal, individual journey. So it's important to recognize that what I experienced is going to be different than what my wife experienced, and my perceptions of it are going to be limited to me, even though the actual challenge is also together. So that's just an insight there, but very interesting. Obviously having that in the portfolio, I'm really happy about participating. I know.
Thank you for joining us.
Yeah. And I look forward to more opportunities and to seeing updates on that over time. I guess I like to wrap up with a question. And my number one question I really have for you is who, if you could just give me 1 second, I want to expand this because I have it written down. But who are some colleagues or other people in the industry that you admire or that you really look up to or that you feel like are doing things, really well in the angel investing space?
Oh, that's a good question. Who are doing things well?
Who do you admire?
Yeah, well, I mean, I do read a lot about kind of some of the VC greats, or I read blog. So read Fred Wilson's blog very religiously. He's not an angel; he's a very established VC.
I love avc.com.
I love his transparency. Absolutely, I read him a lot. I read all of Sam Altman's blog posts. They're less frequent. Peter Thiel is a controversial figure, but I really think everything he says is super thought provoking. So love watching him when he talks and reading everything that he says. Reading Scott Kapoor's book right now, Secrets to Sandhill Road, and I think it's been very good, very thoughtful and educational. I know this doesn't answer your question quite exactly in terms of angels. I think these are all basically VCs. I guess I'll leave my question there. Those are the people that I read the most and respect, and then I spend a lot of time on VC Twitter as well, just following kind of the latest happenings. See what people are talking about.
is there anybody specifically that you think is worth following besides for following you and Unpopular Ventures?
Not really, to be honest. Nobody's coming to mind. I'm sorry to say. I wish I could. No, sorry. I don't have anyone very specific, but I think
Fair enough.
Following just everything in aggregate is pretty interesting.
I mean, those are great choices. I mean, Fred Wilson is just amazing. Although I wonder how he feels about these syndicate investments, because I remember it was probably 2014, 2015 at an event, he was really upset about these companies, these VC funds raising $500 million or these huge funds. He said it was causing all sorts of, I guess, problems that, they were paying crazy valuations, so they couldn't get access to the right deals, or he felt like it was irresponsible. So I wonder if he thinks this is helping the market. Obviously LPs in a syndicate can help be early customers. They could help grow a company. They could, help with specific asks from founders. But I don't recall if he ever wrote anything about it. But I'd be curious his thoughts on the topic. But Fred's amazing, and Sam Altman also. I can't think of anything I've ever seen, like videos of him or tweets or blog posts, that wasn't deeply insightful. And the others, Peter Thiel and Scott, before, I haven't followed their stuff as closely, although I probably should. That's very interesting. And then I guess to wrap up, where can someone find you if they're both a founder that has a deal, or is there a good way to reach you? And also, if someone's interested in being an LP, what would be the best ways to get a hold of you or to find you?
Yeah, you can find us at unpopular.vc. That routes straight to our main webpage, which is on AngelList. In terms of founders approaching us, we do. I know this is kind of a stereotypical old stodgy VC thing, but we do rely heavily on warm intros, or I in particular. Some of my partners look at a lot more cold stuff, but we do tend to be inundated with cold emails. I probably get at least 30 a day. And it's really hard for me to kind of look through all of them and figure out what is worth spending time on. And so I actually rely heavily on warm intros. And the best warm intro you can get is from one of our portfolio CEOs. I always read the emails from our portfolio founders and CEOs, and we have a lot of them. We have over 150 companies we've invested in. You're right that we've done over 193 investments. We've had follow-ons, but the warm intro thing, in a way, it's kind of like a test of a founder's hustle. Can they kind of figure out how to get to somebody and make the case to them and convince them to make the intro onto who they're trying to get to? So anyway, I find referrals from our portfolio CEOs very helpful, and I take a lot, like almost all of those meetings when our portfolio founders and CEOs refer companies. So anyway, for LPs, you can find us at unpopular.vc. And for founders who are looking for funding from us, the best way is to try to get it through one of our portfolio founders, or an LP if we listen to our LPs.
I appreciate that. Very cool. So I was talking. We're talking today with this is Peter Livingston from Unpopular Ventures, and I'm David Mohammed, the host of Fixing Incentives podcast. And until next time, have a great day.
Thanks for listening to the Fixing Incentives podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.